Every month, billions of dollars flow into ETFs that promise to protect investors from losses or multiply their gains. Those promises deserve a closer look. Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. In this video, we'll show the reality behind the marketing pitches for 4 types of risk-managed and levered ETFs. Each of these ETF types applies a multiplier, which mutes or amplifies the return of a reference investment. For each, the possibility of good outcomes is emphasized in the marketing, but in reality, that's offset by the possibility of bad outcomes. And as I'll show you here, you can replicate each of them effectively with a simple do-it-yourself alternative. We'll start with option income ETFs using the JP Morgan Equity Premium Income ETF, ticker JEPI, J-E-P-I, as our example. This ETF has attracted $44 billion in assets and has a 0.35% expense ratio. The do-it-yourself alternative is to invest 60% in the S&P 500 and 40% in U.S. Treasury bills. The marketing for JEPI says it will capture a majority of the returns associated with the S&P 500 with less volatility. That's all true, but the do-it-yourself alternative achieves that objective more effectively. The marketing also emphasizes the high dividend yield. It is indeed high, but the way that JEPI boosts the yield is by taking away from the capital gains. That makes the tax treatment much worse for taxable investors because JEPI's income is taxed at ordinary income tax rates and not the lower rates that apply to capital gains and qualified dividends. Let's compare JEPI to the do-it-yourself alternative. In the 5 years from June 11, 2021 to June 12, 2026, the S&P 500 total return was 13.4% per year, the green line in this chart. The JEPI return was 7.4% per year, the orange line here. The 60-40 do-it-yourself alternative had approximately the same risk, but delivered a much better 9.7% per year return. That's the light blue line here. So JEPI gave you the worst of both worlds, less upside and worse tax treatment than the simple 60-40 strategy. The second category of risk-managed ETFs examined here are so-called Buffer ETFs. Our example ETF will be BUFR, the FT Vest Laddered Buffer ETF. That has $9 billion in assets and a 0.95% expense ratio. The do-it-yourself alternative is the same as we had for JEPI, 60% in the S&P 500 and 40% in U.S. Treasury bills. The marketing claims that the BUFR ETF is providing investors with U.S. large-cap equity market exposure while limiting downside risk. That's true, but 60-40 stocks bills has about the same outcome. So you're paying nearly 1% per year for a product that delivered a result you could have obtained for free. BUFR also claims to be providing a buffer against the first 10% of S&P 500 losses. However, there's not only a downside buffer, but there's also an upside buffer which limits the gains. This chart makes the point plainly. BUFR and the do-it-yourself 60-40 option were nearly indistinguishable over the past 5 years, except 60-40 cost you nothing extra. Levered bull index ETFs are the next category to discuss. Our case study is SPXL, the Direxion Daily S&P 500 3 times bull ETF. That one has $7 billion in assets and a 0.87% expense ratio. The marketing says that SPXL seeks 300% of the performance of the S&P 500. SPXL definitely has 3 times the risk of the S&P 500, but the fund can fall far short of its 3x return target. The fund manager's own disclosures acknowledge it can even lose money when the S&P 500 goes up, as happened in the 2022 to 2023 period with this product. Daily rebalancing leads to transaction costs and volatility decay. And in addition, the leverage comes at a cost, which reduces the return. The curse of these leverage strategies is volatility decay. So here's an example. Suppose the S&P 500 rises 12% on day one and falls 10% the next day. An unlevered S&P 500 investor would have a net gain of 0.8% after those 2 days. An investor in SPXL, the 3x levered product, would earn 36% on day one, followed by a 30% loss on day two, ending up with a net loss of 4.8%. So the SPXL investor hoped to get triple the S&P 500 return, which would have been positive 2.4%, but they got negative 4.8% instead. That's the volatility decay. Every zigzag in the market compounds the damage. The more volatile the market, the farther SPXL will fall from its goal. If you invested $100,000 in SPXL in mid-June 2021, you would have earned a return of 21.6% per year by mid-June 2026, which is 1.6 times the S&P 500 return. Another way to get to a similar place would have been to take on a margin loan of $200,000 and then invest $300,000 in the S&P 500. That would have generated a better return of 24.1% per year with a similar trajectory. So with SPXL, you took triple the risk of the index to get 1.6 times the return. And that's a bad trade-off overall, and it's worse than the do-it-yourself alternative. In addition to these levered bull strategies, the ETF world also offers levered bear strategies. Our example here is SPXU, the ProShares Ultra Pro 3x short S&P 500. It has 0.4 billion in assets and a 0.9% expense ratio. The 0.4 billion underrepresents the impact of levered bear ETFs like this one. If you had invested $100 billion in SPXU 10 years ago, your investment would have collapsed to that number, just $400 million today, a 99.6% loss. The do-it-yourself alternative to this is to go 300% short the S&P 500 index and 400% long in U.S. Treasury bills, but we don't advise that either. These levered short strategies are similar to the levered long strategies in that the outcome can vary significantly from the objective. Moreover, the volatility decay from levered short is even worse than it is for levered long. It's quite harmful to own a levered bear ETF during a bull market. A $100,000 investment in SPXU 5 years ago would be worth just $12,000 today. An 88% loss, a return of minus 34% per year, which is 2.5 times, that is negative 2.5 times the 13.4% return of the S&P 500. The do-it-yourself equivalent would have exhausted the entire investment in roughly 3 years and then continued to generate losses. The pattern across all four of these categories is the same. The marketing highlights the attractive possibility, downside protection, yield, amplified gains, while glossing over the costs and the potential for unattractive outcomes. In the three types of long ETFs, a simple do-it-yourself alternative using the underlying index and treasury bills achieved a better outcome with less cost and more transparency. If someone is recommending one of these products to you, it's worthwhile to ask them to show you what the do-it-yourself version would have done and then decide. Finally, a triple leveraged short bear strategy is just unsuitable for nearly everyone, whether in ETF form or do-it-yourself. Thank you for listening. If you're currently holding one of these ETFs or something similar and you'd like to understand the true costs, we're happy to run the numbers for you. Thanks.